Hello everyone, myself Sridharan from Wealth Ladder. Hope everybody is safe. So now in this series we are going to talk about how to select the best, the debt mutual funds. If you look at last week, Franklin has, wind up, 6 of their schemes for purchasing and redemption. So does it mean that the debt funds are calling it as debt funds? Not it. So basically, the debt funds actually, we can categorize into two different categories. One is actually the accrual funds. The second one is the credit managed funds. So the accrual funds are primarily, a kind of a short-term funds which will accrue the interest on the schemes. Whereas the credit managed funds will be investing in bonds and then, they predominantly invest in long-term papers. So the credit risk funds primarily, invest in AA rated papers and AAA rated papers. So when we are investing in the debt funds, we need to look at the three things. One is the quality of the, the funds that they are, quality of the companies that they are investing in. Second is we need to look at what is the duration of the funds. And third is that we need to look at is what is the yield, the potential yield the fund can deliver. So as far as the short-term funds are concerned, the liquid funds, money market and ultra short-term low duration funds are the best funds. So they will have a duration which will range between 91 days to, it may vary up to 180 days or even 365 days. So the short-term maturity papers, primarily they call it as, they are rated as A1, A2 and A3. So the A1 is actually the high quality paper compared to a A2 or A3. So when you are investing in short-term funds, you need to look at the high quality papers which are predominantly A1. And sovereign bonds is what actually something they will look at it. So the high quality papers along with the maturity duration which is less than 1 year would be the best funds for selecting the short term. Third is, when we are talking about yield to maturity, that is the potential return one can expect from the underlying portfolio. So though, we are getting, little less return on the high quality papers, that could be more safest. So when we are talking about the long-term duration papers and especially the bonds, so the long-term bonds primarily, they will be giving you returns based on the quality of papers. So basically, this will be rated as A, AA, AAA, and then they call it as B, C, and default will be considered as D. The more and more the quality papers that they are investing in, the returns will be lower. So primarily, you should not look at investing in credit risk or a medium-term funds right now, because this can be a kind of a managed credit risk funds which will potentially yield you better returns, but the underlying portfolio carries a high risk. Secondly, the credit risk funds will be considered as investing as a small cap funds, because the duration of these funds will typically between 3 to 5 years maturity. So the longer the maturity papers, the lower the credit risk credit portfolio, and the higher the return is what the typical quality of the credit risk funds. So at this juncture, so we recommend you to avoid investing in credit risk and medium term funds. It is better to stay with short duration, high quality papers that will provide you, though a lesser return, but considerably it is safe. Thank you.